Welcome to Talk Tickers, the deep dive designed to get you inside the crucial analysis of earnings calls, helping you sort the signal from the noise.
And today we are cracking open the Q3 2025 earnings for Pacific Biosciences, or PACB. They're a really key player in the long read sequencing space.
And what a quarter.
Yeah.
I mean, the core tension here was just this massive clash. You had management on the call hammering home these huge operational wins.
Oh, yeah. Big margin improvements, strategic changes.
Right, but the market just, it completely ignored all of it. The second those revenue numbers dropped, investors just hit the sell button, a really significant negative reaction.
And that's exactly what we need to unpack for you here. Why did that happen? Because, on paper, the bottom line performance was actually pretty stellar.
So we need to figure out what management achieved versus what risks the market is so fixated on.
Exactly.
Okay, so let's start with that headline snapshot. What were the actual numbers that caused all this whiplash?
So the good news, the immediate good news, was on the bottom line. Non-GAAP EPS came in at a loss of 12 cents.
And the consensus was looking for a loss of 16 cents.
Yeah.
So that's a pretty solid beat.
A very solid beat. And it goes deeper than that. The actual GAAP net loss, it improved dramatically. It shrank to $38 million from, over $60 million a year ago?
Wow. So you cut your net loss by nearly a third in just a year. That shows some serious internal control.
It really does. But, this is a growth company. And for companies like this, the market grades you on growth first. And that's where the trouble started.
The top line.
The top line, revenue was $38.4 million, but the street was looking for almost $40 million.
So a miss. And not just a miss, but it was actually year-over-year decline of almost 4%. You can't really have a negative growth number when you're in a high-growth sector.
And the market chose its side immediately. There was this little spike in after-hours trading when the EPS number hit, but then, boom, the stock sold off hard.
The signal from investors is pretty clear then. Great job on the cost-cutting, but we need to see instrument sales. We need growth.
That's the message.
Okay, so if revenue was the problem, let's dig into what management says they're doing right. I mean, these internal shifts that are supposed to be improving the company. Let's start with that product mix pivot.
Yes, this is the story the bulls are hanging their hats on. And honestly, they're executing it perfectly. They're moving away from just selling big, expensive machines.
Or one-and-done capital sale.
Exactly. To a recurring revenue model. Consumables. And this quarter, consumable revenue hit a record, $21.3 million. That's up 15% year over year.
So what does that do for the business as a whole?
It changes the entire profile of the company. Consumables are now about 55% of total revenue. Just a year ago, that number was 46%.
And that shift translates directly into better margins, right? Because the razor blades are always more profitable than the razor.
Always. Which brings us to the margin story, which is, it's pretty astonishing, actually. Non-GAAP gross margin just soared to 42%.
42. You have to let that sink in. Last year, in Q3 2024, it was 33%. That's a 900 basis point expansion.
It is not an incremental tweak. That's a fundamental change in how the business operates.
So how did they do it? Is it purely that mix shift?
That's a huge part of it, yes. But they also pointed to better manufacturing yields for their Revio smart cells. So they're getting more efficient at making the most critical, most expensive part of the process.
Okay, so they're transitioning the model and making the core of that new model cheaper to produce. But that has to be paired with some serious belt tightening.
Oh, absolutely. They showed a real commitment to cost control. Non-GAAP OpEx dropped by almost 14% year over year. And, part of that was some painful restructuring. Headcount is down to 490 from 575 at the end of last year.
They're getting lean to buy themselves time. And this all feeds into their biggest long-term promise, doesn't it?
It makes their 2027 cash flow break-even target seem much more credible. Their cash burn improved. They still have almost $300 million in cash. It gives them a runway.
A runway to get through this period of, soft instrument sales. Which I guess brings us to the elephant in the room, that 33% drop in instrument revenue.
Right. This is the heart of the execution risk story. On their main machine, the Revio, they only shipped 13 systems. That's down from 22 a year ago.
Ouch. And their explanation.
Management said it was about strategic placements and lower average selling prices, or ASPs.
Which sounds like they're just discounting to move boxes. Isn't that a risk? You're just pulling future high-margin sales into today at a lower price.
That's the friction. That's what the skeptics are pointing to. Management's argument is that it's all about the long-term consumables pull-through. They're saying, look, we'll take less money today to get this machine into a lab that will use it like crazy tomorrow.
Is there any proof that strategy is working?
Well, this is their proof point. The Revio annualized pull-through per system was $236,000. That's near the high end of their range.
Okay, so the customers who do have the machines are using them a lot.
Exactly. For the bulls, that validates the whole strategy. For the skeptics, they're worried that number isn't durable if the install base grows too slowly.
And what about the smaller system, the Vega?
Vega also came in below forecasts. 32 systems shipped. But here, management was adamant it wasn't a demand problem, it was timing. They said about half a dozen big tenders in Europe just slipped into Q4, procurement cycles.
So that's just revenue getting pushed from one quarter to the next.
That's the story. And they said some of those purchase orders are already in hand for Q4, which supports their forecast. Plus, 60% of those Vegas went to brand new customers, which is great for expanding their ecosystem.
So the real problem isn't demand, it's timing and price concessions, which I guess leads us to the future catalysts. I mean, the big one, the path to the holy grail of sequencing.
The holy grail, that's the perfect way to put it. They announced their new SPRQ-Nx chemistry. This is the big technology story that long-term investors are focused on because it tackles the single biggest barrier to adoption cost.
They're talking about a 40% reduction in cost per genome.
Which gets you to a sub-$300 long-read genome. That is a market-altering price point. It takes this technology out of the niche research corner and makes it competitive for population-scale studies, for clinical use.
And how are they doing it? The technology sounds kind of revolutionary.
It is. They're introducing a multi-use smart cell. Think of the smart cell as the really, really expensive ink cartridge for the printer. It used to be single use.
And now you can reuse it.
Now you can reuse it, which is a huge win for customer economics. But here's the brilliant part. It also improves PACB's own gross margins. It's a true win-win that changes the whole financial model.
And this isn't just a science project. They said beta testing starts now in Q4 with a full rollout in 2026. This is near term.
It's very real. And that tech advantage is starting to translate into clinical wins, which is so important to get them out of that lumpy academic funding cycle.
Like what? What do they highlight?
The big one was a Class 3 regulatory registration for one of their systems in China.
Why is an approval in China so important?
Because it's the first regulatory approval for a clinical-grade long-read sequencer anywhere in the world. It fundamentally changes the perception of the platform from a research toy to a real diagnostic tool.
Which opens up huge regulated markets. And we also saw other signs, right? Like that study with Children's Mercy Hospital.
Yes, exactly. They're launching a single hi-fi-based test to replace a whole bunch of older, clunkier workflows in things like pediatric oncology. That kind of efficiency is exactly what hospital systems want to see.
Okay, so let's tie this all together for the investor. You have these massive tech catalysts and margin growth, but it's set against a revenue miss and a tough macro environment. Management narrowed their guidance for the full year.
Right, they brought the range down to 155 to 160 million, which basically anchors to the low end of where they were before. That added fuel to the fire for the skeptics.
And they're warning that the tough funding environment, especially in the Americas, is probably going to continue into 2026.
It is. And this backdrop creates this huge divide in how people see the stock. On one side, you have the bulls. They're looking right past this quarter's lumpiness. They see the tech moat with SPRQ-Nx, the clinical wins, the huge market growth.
And on the other side, the skeptics. They're just focused on right now.
Yeah.
The revenue miss, the discounting, the cash burn. They want to see consistent top-line growth before they're willing to pay up for the stock.
And the whole debate really boils down to one question. Will the discounting strategy work? Will these machines they're placing now actually turn into that high-margin, predictable consumables revenue they need to hit that 2027 break-even goal?
That uncertainty is the opportunity. Which brings us to our segment where we pitch an outrageous but plausible trade idea.
And, as always, the big disclaimer. This is a hypothetical pitch. It's an exercise in strategic thinking. It is not financial advice.
Okay, so the pitch here is to exploit that gap we just talked about. The market is punishing the near-term execution failure and completely ignoring the long-term margin and technology success.
The market is acting like this instrument lumpiness is a permanent flaw, while the 900 basis point margin gain and the SPRQ-Nx chemistry are just, footnotes.
We think the market's focus is way too short-term. They're looking at the next 2 quarters, not the next 2 years. That SPRQ-Nx chemistry, getting to a $300 genome, that's the key that unlocks everything.
It's what's needed to hit that 2027 break-even target.
So the trade is a high-leverage bullish bet that this operational pivot actually succeeds. The specific idea is to buy long-dated call options. We're talking 2027 expiry.
The duration is critical. You're giving the story time to play out. You're betting that by 2027, the full launch of SPRQ-Nx in 26 and the market adoption that follows will make today's execution fears look, well, trivial.
It's a bet that the technology adoption curve will overwhelm the temporary anxiety around sales cycles.
A bet on the tech moat, plain and simple.
I like the logic.
Yeah.
Okay, to wrap this deep dive up, the main takeaway from PCB's Q3 is pretty stark, isn't it?
It is. The company showed incredible internal discipline, great operational control, fantastic margin growth. But the top-line miss created this huge cloud of anxiety for investors who need to see that near-term execution.
Which sets up this really profound inflection point. And that brings us to our final provocative thought for you, centered on that multi-use smart cell. If the entire next generation of sequencing economics is built on reusing your most expensive consumable,
Instead of just replacing it every single time.
does that completely change how you should value a company's install base?
Yeah.
Does the metric of success shift away from just counting the number of boxes shipped and move almost entirely to the utilization rate of every single machine out in the field?
Something to think about as you digest the future of genomics.
That's all the time we have for this deep dive. Thank you for joining us on Talk Tickers.